Look around you right now. The money in your bank account, the salary that hits every 2 weeks, the savings you've been quietly building for years, the pension that's been promised to you. All of it feels solid, permanent, real. It isn't. Not because you've done anything wrong, not because your bank is about to collapse or your government is about to fall, but because of something deeper and more unsettling than any of that. Every financial system in human history, every single one, has eventually broken. Not some of them, not most of them, all of them. The currencies that seemed unshakable, the banks that seemed untouchable, the empires whose financial architecture seemed as permanent as stone, they all reached a point where the trust that held them together dissolved. And when trust dissolves, the system doesn't weaken. It evaporates. This is not a fringe view. It is the central lesson of 3,000 years of recorded financial history. Collapse is not the exception. Collapse is the rule. Stability is the exception, a temporary condition that persists only as long as the right combination of trust, restraint, and circumstance holds together. Now, before you decide this is another doom and gloom video designed to make you anxious, I want to tell you something important. The people who understood this, who studied these patterns and took them seriously, did not lose everything when the systems around them failed. They survived. Many of them prospered. Not because they were lucky, and not because they were reckless speculators, but because they understood what money actually is, what it is not, and what kinds of value endure when the paper promises stop being honored. History has the answers. We just have to be willing to look at them clearly. Let's start with the most important thing most people never learn about money. Money is not a thing. It is a relationship. It is a collective agreement, a shared fiction that works only as long as enough people believe in it simultaneously. The paper in your wallet has no intrinsic value. The number in your bank account is a digital entry in a ledger. Even gold, which we treat as the ultimate backstop, derives its monetary value from a human consensus that has persisted for thousands of years, not from any physical property that makes it essential to survival. What this means is that the foundation of every financial system is not a vault or a reserve or a law. It is trust. And trust, as history demonstrates with brutal consistency, is fragile in ways that vaults and reserves and laws are not. When people lose faith in a currency, when they stop believing that the money they hold today will be worth something tomorrow, the collapse does not happen slowly. It happens with terrifying speed. A currency can hold its value for decades and then lose 90% of it in months. A bank can stand for a century and fail in 72 hours. The apparent solidity of these systems is not evidence of their strength. It is evidence of how completely trust conceals their fragility. This has happened everywhere, at every scale, in every era. Let's walk through the evidence. Start with one of the most successful monetary experiments in human history. The Byzantine Empire's gold coin, the solidus, was the dominant currency of international trade for more than 700 years. From the 4th century to the 11th, merchants from China to Scandinavia accepted it. It was the dollar of the medieval world. Its reliability was so well established that it was called the currency that never devalues. And the emperors started shaving it. Not all at once, not dramatically. Gradually, across several reigns, the gold content of the solidus was reduced, mixed with silver, then copper, then base metals, to fund military campaigns, to service debts to cover the chronic gap between what the empire spent and what it collected. Each individual debasement was small enough to be explained away. Taken together, they were catastrophic. By the 11th century, a coin that had once been 24 carats of pure gold contained less than 8 carats of actual gold. Merchants who had built trade networks on the reliability of Byzantine currency found that the instrument of trust had become an instrument of deception. They stopped accepting it at face value. They started weighing and testing it. The trade networks that had depended on frictionless exchange began to seize up. The commercial relationships that had made Byzantium rich and powerful, relationships built over centuries, unraveled within decades. The lesson is not that empires fall. The lesson is the mechanism. The Byzantine solidus did not fail because of external invasion or natural disaster. It failed because the people trusted to protect the currency could not resist the short-term temptation to debase it. And that temptation, the temptation to solve today's fiscal problem by quietly stealing from everyone who holds your currency, is not a Byzantine weakness. It is a human constant. Every government in history that has controlled a currency has eventually given in to it. Every single one. The question is never whether debasement will happen. The question is how fast and whether you see it coming. Now, let's talk about the most dangerous phrase in finance. Too big to fail. In 14th century Florence, two banking families, the Bardi and the Peruzzi, had built what were, by any reasonable measure, the most sophisticated financial institutions in the world. They had branches across Europe and the Mediterranean. They financed popes and monarchs. They had invented instruments of credit that would not be matched in sophistication for centuries. They were, by the standards of their time, the financial system. Not a part of it, the whole of it. And they lent enormous sums to the kings of England and Naples. When Edward III of England defaulted on his debts in the 1340s, when he simply decided that the money he owed the Florentine bankers was a problem he no longer intended to solve, the Bardi and Peruzzi had no recourse. You cannot repossess a kingdom. You cannot sue a king in a court he controls. The loans were gone. The capital that had funded decades of expansion, that had been lent out in 100 directions, that had formed the backbone of the most important financial network in medieval Europe, it was gone. Both banks collapsed. The financial shock rippled through Florence and beyond, contributing to one of the deepest economic contractions of the medieval period. Businesses that had nothing to do with English royal finance found themselves without credit, without liquidity, caught in a cascading failure they had no warning of and no defense against. 7 centuries later, the script was nearly identical. In 2008, the banks that failed or nearly failed were not obscure institutions. They were Lehman Brothers, with 150 years of history. They were Bear Stearns, Washington Mutual, Wachovia. They were the institutions that the financial world had decided were too interconnected, too important, too large to be allowed to fail. And yet they failed, or came within hours of failing, or required the largest government bailouts in history to prevent their failure. Size is not safety. Reputation is not protection. The Bardi were too big to fail in 1340. Lehman Brothers was too big to fail in 2008. History is not impressed by either argument. There's a moment in every monetary collapse when the government makes a choice. It can accept the pain of fiscal reality, cut spending, raise taxes, default on debt, and absorb the political consequences. Or it can print money to create currency, manufacture the appearance of wealth from nothing, and push the real cost into the future in the form of inflation. Governments almost always choose to print. And the reason is simple. The pain of printing is invisible at first. The pain of austerity is immediate. Politicians are not rewarded for accepting visible pain. They are rewarded for deferring it. Revolutionary France provides the cleanest case study in what happens next. In 1789, the new French government inherited a fiscal catastrophe from the monarchy it had just overthrown. It needed money desperately and had no reliable way to raise it. The solution it landed on was the assignat, a paper currency backed, theoretically, by the value of confiscated church and aristocratic lands. The idea was elegant. Issue paper money against real assets, sell the land over time, retire the paper. The execution was a disaster. The government printed more assignats than the land could back. Then it printed more. Each round of printing was justified by necessity. War, administrative costs, political crisis. Each round further diluted the value of the currency already in circulation. By 1796, the assignat had lost approximately 97% of its face value. A note that had been worth 100 livres was worth 3. What happened in the real economy is the part that stays with you. Farmers, who grew the food that everyone needed, stopped accepting paper. They had watched their savings evaporate. They understood, through lived experience rather than economic theory, that a government printing press was not a guarantee of value. They demanded payment in coin, in kind, in anything that couldn't be replicated by a government decree. Cities went hungry, not because there was no food, but because the instrument of exchange had been destroyed. The mechanism that allowed a baker to pay a farmer and a farmer to pay a blacksmith and a blacksmith to pay a doctor, that mechanism had been inflated into worthlessness. And when the mechanism fails, the economy does not find an alternative smoothly. It seizes, people hoard, supply chains collapse, the most basic transactions become fraught with suspicion. The farmers who survived that period, who insisted on tangible payment and held their grain and their land, were not being irrational. They were being precisely rational in a way that the people who trusted the paper were not. The American Civil War ran 2 monetary experiments simultaneously, and the contrast between them is one of the most instructive in financial history. The Confederate States of America issued their own currency, the Confederate dollar, known colloquially as the grayback. It was backed by nothing except the promise of a government that was fighting for its existence against a larger, better resourced enemy. As the war went badly for the South, as territory was lost and supply lines were cut and the prospect of Confederate victory dimmed, the value of that currency tracked the confidence in Confederate survival almost perfectly. By the end of the war, inflation in the Confederacy had reached approximately 9,000%. The currency was not just worthless. It was a historical artifact before the ink was dry. The Union also printed fiat currency, the greenback, and also experienced significant inflation. But there is a crucial difference worth examining. The Union was fighting from a position of industrial and economic superiority. Its currency, though not backed by gold during the war, was backed by the productive capacity of an economy that everyone could observe was winning. When the war ended, greenbacks were eventually redeemed and stabilized. They became the foundation of a monetary system that lasted decades. Same instrument, same era, radically different outcomes. The lesson is not that paper money always fails. The lesson is that paper money is only as good as the productive reality behind it. A currency backed by nothing but a losing cause evaporates with that cause. A currency backed by a functioning, growing economy, even imperfectly, even with significant inflation, can survive and eventually stabilize. This distinction matters enormously when you are trying to assess the durability of any modern currency. The question is not whether it is backed by gold. The question is whether it is backed by a productive economy, a functioning legal system, and a government with enough credibility to honor its commitments. Those things can erode too, but they erode more slowly and with more warning than a Confederate dollar in the spring of 1865. One of the most counterintuitive lessons in financial history is this: the worst catastrophes are also, for some people, the greatest opportunities. Not because catastrophe is good. It is not, but because catastrophe redistributes. It destroys some forms of value and elevates others. It kills some participants and empowers the survivors. And the people who understand which values survive a catastrophe, who hold those values going into it, emerge in a fundamentally different position than those who don't. The Black Death killed between a third and a half of Europe's population between 1347 and 1351. It was the most catastrophic demographic event in recorded Western history. And in its immediate aftermath, something economically remarkable happened. Labor became scarce, dramatically, suddenly, structurally scarce. Serfs who had been legally bound to land and lord found themselves with negotiating power they had never possessed. Wages rose sharply. The rigid feudal hierarchy that had kept the lower classes in permanent poverty began to crack, not because of political revolution, but because the economics of scarcity had shifted in favor of those who survived and could work. Landowners who had depended on cheap, captive labor found their model broken. Craftsmen and skilled tradespeople, those who possessed productive skills that could not easily be replaced, found their position transformed almost overnight. Now compare that to 2020. COVID-19 killed far fewer people as a percentage of the population than the Black Death. But it produced a different kind of redistribution, not of labor value, but of financial position. Governments injected trillions of dollars into financial systems. Interest rates were cut to near zero. Asset prices, already elevated, surged. Those who owned financial assets, stocks, real estate, investment portfolios, saw their wealth increase substantially during a period when millions of people were losing their livelihoods. This is the Cantillon effect in its most visible modern form. The people closest to the new money, the asset owners, the financial institutions, the primary dealers, captured the benefit. The people furthest from it, the hourly workers, the renters, the unbanked, absorbed the cost in the form of inflation that arrived after the stimulus, and grocery bills and rent increases and car insurance that their wages did not keep pace with. Two pandemics, 6.5 centuries apart. Both redistributive, both creating winners and losers according to the same underlying logic. Those who hold productive skills or tangible assets enter crises with options. Those who hold only paper claims on a system under stress find those claims revalued without their consent. In 1997, a crisis that began with a single currency devaluation in Thailand spread across East Asia with a speed and ferocity that stunned economists and policymakers who had spent years praising the region's growth model. Thailand, Indonesia, South Korea, Malaysia, these were the so-called Asian tigers. They had delivered decades of remarkable economic growth. Their financial systems were considered models for the developing world. And they shared a structural vulnerability that almost nobody was talking about. Enormous amounts of debt denominated in foreign currencies, primarily the US dollar. When you borrow in a foreign currency, you're making a bet that your own currency will remain stable relative to it. As long as that bet holds, the arrangement works. When it doesn't, when your currency devalues against the currency your debt is denominated in, the arithmetic becomes catastrophic with no warning and no gradual adjustment. Your debt, measured in your own currency, can double or triple overnight. Not because you borrowed more, because the exchange rate moved. In Indonesia, the rupiah lost 70% of its value against the dollar within months. Companies that had been perfectly solvent, that could service their debts comfortably at the old exchange rate, became insolvent at the new one. Banks that had lent to those companies found their loan books destroyed. The government, trying to defend the currency, burned through its foreign exchange reserves. The International Monetary Fund arrived with emergency loans attached to austerity conditions that triggered social unrest, and, in Indonesia's case, the fall of a government that had been in power for 32 years. The families that came through that crisis with their economic position intact shared certain characteristics. They had limited foreign currency debt. They held assets that retained value in any denomination: land, productive businesses, practical skills. They were not dependent on the continued functioning of financial institutions that turned out to be far more fragile than their size suggested. The trap of foreign currency debt is not ancient history. It is the situation of dozens of countries right now, borrowing in dollars or euros while earning in currencies that can devalue. The Asian financial crisis is the template for what happens when that arrangement encounters stress. And the template is always the same. The crisis arrives faster than anyone expected. The damage is worse than the models predicted, and the people who survive are the ones who were not dependent on the system holding together. You do not have to go back to the 14th century or the 19th to find a case study in financial collapse. You only have to look at Lebanon between 2019 and 2021. Lebanon was, for much of the 20th century, considered the financial capital of the Middle East. Beirut was called the Paris of the East. Its banking sector was sophisticated, its deposits were large, and for decades the Lebanese pound was pegged to the US dollar at a rate of 0.500 to 1, a peg that had held so long and so consistently that most Lebanese treated it as a permanent fact of life. It was not a permanent fact of life. It was a fragile arrangement maintained by capital inflows that eventually stopped coming. When the financial system began to crack in late 2019, the response of Lebanese banks was immediate and, for most depositors, completely unexpected. Banks imposed informal capital controls, limits on how much cash customers could withdraw, restrictions on transferring money abroad. These controls were not authorized by any law. They were simply implemented unilaterally by banks that were insolvent and needed to prevent a run. People who had spent decades faithfully depositing their savings into Lebanese banks, who had done everything right by conventional financial wisdom, found that their money was inaccessible. Not stolen, technically, not gone officially, just unavailable. Frozen behind a counter they could stand in front of and be told, politely, that their own savings could not be returned to them today. The Lebanese pound, meanwhile, collapsed. The official rate of 1/500 to the dollar held on paper for a while, maintained by a central bank that was running out of reserves. The black market rate, the rate at which Lebanese could actually exchange their pounds for dollars, told a different story. By 2021, it had reached roughly 15,000 to the dollar, a 90% collapse in purchasing power, in less than 2 years. The people who came through that crisis with something intact were not the ones who had trusted the banking system most faithfully. They were the ones who had maintained dollar savings outside the banking system, who owned property that held value in any currency, who had productive skills, doctors, engineers, craftspeople, whose ability to generate income did not depend on the Lebanese financial system continuing to function. This is not a story about a poor country making poor decisions. Lebanon had a banking sector that regulators praised, a currency peg that had held for decades, and a professional class that was educated, financially literate, and globally connected. None of that protected the people who had trusted the system completely. The system broke anyway. The lesson it teaches is not unique to Lebanon. It is the same lesson the Byzantine Empire taught, in revolutionary France and the Confederacy, in 1997 Indonesia. The system will tell you it is safe, right up until it isn't. So what actually survives when money fails? The answer that most people reach for first is gold. And gold is not wrong. It has preserved purchasing power across 5,000 years of monetary history in a way that no paper currency has managed. The Byzantine solidus was gold. The reason it lasted 700 years is that 700 years of merchants and emperors could not talk themselves out of the consensus that gold was valuable. That consensus has never fully broken down across all civilizations simultaneously, which is why gold remains a monetary anchor of last resort, even in an era of digital finance. But gold is not the complete answer, and the people who focus only on gold are missing something that history makes equally clear. Land survives. The French farmer who refused the assignat and demanded payment in kind was not wrong. The earth that grew the food was real, in a way that the paper was not. Productive land that generates food, energy, or other necessities, has retained value through every collapse in history because the things it produces cannot be inflated away. You cannot print more wheat. You cannot debase an acre. Productive skills survive. This is the lesson that is most often omitted from the gold and land conversation, and it is possibly the most important one. The craftsperson, the farmer, the doctor, the engineer, the builder, anyone who can create genuine value with their hands and knowledge, does not depend on any financial system to generate an income. When the monetary system fails and barter becomes necessary, the person who can fix a roof or deliver a baby or repair an engine is not at the mercy of anyone. Their human capital is not held in a bank account. It cannot be frozen, devalued, or confiscated. In Weimar Germany, while middle-class families who held their savings in German marks watched decades of accumulation evaporate in months, skilled tradespeople and farmers continued to work, not comfortably. Hyperinflation was devastating for almost everyone, but the person who could make something real, fix something broken, grow something edible, was trading in a currency that the Reichsbank could not debase. Their skill was their hedge. Liquidity survives when carefully held. This is the distinction between the person who is wiped out by a crisis and the person who emerges from it with the ability to act. When asset prices collapse, when a financial crisis or currency failure causes real estate, businesses, and equity values to crash, the person who holds liquid value that has survived the crash can purchase those assets at a fraction of their eventual recovery value. The 2008 financial crisis created the largest transfer of real estate wealth in modern American history. The people who bought distressed properties between 2009 and 2012 made fortunes. Those people had liquidity when others did not. That liquidity was not luck. It was the result of not having trusted the system entirely. Networks survive. In every collapse on record, the people who fared best were not necessarily the richest going in. They were the ones who were most embedded in communities of mutual support. People who could rely on each other for food, security, information, and exchange when formal systems stopped functioning. The social capital of knowing people who trust you and whom you can trust is not something that can be quantified on a balance sheet. But it has proven consistently to be one of the most durable forms of value a person can hold. Here is the hardest idea in this video. And I want to be careful about how I say it, because it can easily be misread. Collapse is both a tragedy and an opportunity. Not for everyone, not equally. But structurally, unavoidably, every collapse destroys some forms of value and creates others. Every crisis transfers wealth from those who were holding the wrong things to those who were holding the right ones. That transfer is not fair. The people who lose are often not the ones who made bad decisions. They are the ones who trusted systems they had every reason to believe were trustworthy. That is a genuine injustice, and it deserves to be named as one. But understanding the injustice does not protect you from it. What protects you is understanding the pattern well enough to position yourself differently. The active builder, the person who holds productive skills, tangible assets, and genuine liquidity, enters a crisis with options. They can weather the contraction because their income does not depend entirely on the financial system. They can act during the crisis because they have value that survived the crash. They can rebuild after the crisis because they have the skills and relationships that a recovery requires. The passive saver, the person who entrusted their entire financial future to a system they never questioned, enters a crisis with none of those options. They are at the mercy of whatever the system decides to do with their claims. Lebanon showed us what that looks like in real time. People standing at bank counters being told politely that their money was there but not accessible, watching 90% of its value disappear on the black market while the official rate pretended otherwise. The difference between those two outcomes is not intelligence. It is not luck. It is the specific set of decisions made before the crisis, about what to hold, what to build, what to trust, and what to question. Let me close with this. The financial system you live inside right now is not uniquely fragile, but it is not uniquely strong either. It is a human construction, maintained by human trust, operated by human institutions with human incentives. The governments managing it face the same temptation to debase that every government in history has faced. The banks operating within it carried the same systemic risks that brought down the Bardi, the Peruzzi, Lehman Brothers, and the Lebanese banking sector. The currencies it relies on are backed by the productive capacity and political credibility of the states that issue them, both of which can erode. None of this means collapse is imminent. It means collapse is possible, and the people who take that possibility seriously, who diversify their value across forms that have historically survived monetary failure, who build skills that cannot be inflated away, who maintain the liquidity to act when others cannot, those people are not pessimists. They are the same kind of people who have navigated every great financial transition in history and come out the other side. The Byzantine merchants who stopped trusting debased coin and demanded payment in kind. The Florentine families who survived the Bardi collapse because they were not entirely dependent on a single institution. The skilled tradespeople in Weimar Germany who kept working when paper wealth evaporated. The Lebanese who held their savings outside the banking system before the controls came down. They did not know the specific form the crisis would take. Nobody ever does, but they understood the underlying pattern. They knew that every financial system carries the seeds of its own failure. They knew that the safest position is not the one that trusts the system most completely, but the one that is most resilient to the system's eventual failure. The history is there. It has always been there. The only question is whether we choose to learn from it. What you do with that knowledge, that is up to you.